Hello and good morning. I'm Ed Katashabe from Forex Insights SA. You're watching Traders Next Door, and this is the Daily Scoop. The US dollar has been in a massive bullish market and rallying recently due to persistently high interest rates and the Federal Reserve's hawkish stance on those policies. Maintaining higher rates, the Fed has been able to be has been able to make dollar-denoted assets a little bit more attractive to foreign investment, and this has been contributing heavily to US dollar strength in recent months. But with last week's CPI data, the Fed might be looking to pause rate cuts in the remaining two meetings due to how the data came out. Now, why would the Fed's announcement be important for the US dollar? Well, that's simply because higher interest rates attract foreign investment, increase demand for the dollar, and this is normally positive for the US economy. However, conversely, when the Fed cuts rates, the dollar often loses a little bit of value, and this results in foreign investment looking towards other currencies that look a little bit more attractive. But these rates cannot remain too high for too long without negatively impacting the US citizens. And that's why the Fed every now and again has to cut rates. It's a delicate balancing act of sorts. You want interest rates high to attract foreign investment, but if interest rates remain high for too long, this negatively affects the US citizens, negatively affects their spending, and with the US's economy and GDP largely made up 70% of consumer spending, you can't keep them too high without knocking the economy's growth overall. Hence why we've started this season of rate cuts. So looking at this week's US retail sales, which is one of the indicators of how consumer spending is going, it's going to play a crucial role in determining whether the US dollar's current rally is going to maintain its momentum, or if the Fed needs to take a really hard look and plan at their current interest rates and what they plan to do with it moving forward. Powell's recent messaging has signaled that interest rates are likely at their peak, but emphasized that cutting them too quickly isn't exactly on the table either. This cautious stance sort of underscores the Fed's balancing act. They're going to keep inflation under control without stifling economic growth. So the markets right now are focused on how Powell is going to hint towards the Fed's further outlook for the rest of the year, whether they're going to maintain their rate cutting cycle or if they're going to pivot and pause on further rate cuts this year. Meanwhile, with retail sales data coming out in the next coming days, that is going to be a key indicator of where the strength of the US economy is right now. If the sales are stronger than expected, this could affirm the Fed's hawkish approach by indicating that the economy remains resilient despite the higher borrowing rates. But conversely, a weak retail sales print might lead to market speculation that the Fed could shift towards cutting rates as previously expected in their next meeting. So that is how the dollar is looking right now. We're looking really closely how the data is going to come out, and this is going to impact dollar's trajectory in the markets and affect how traders are going to work with pairs that are related to the dollar. Looking across the pond to our European neighbors, this week we're also getting the UK's Consumer Price Index, CPI, coming out tomorrow, and this is going to be an event to watch. Inflation data in the UK has significant impacts on the Bank of England's policy decisions, and if inflation remains persistently high as it has, the Bank of England may lean towards further tightening on their policy, supporting the pound. Conversely, if inflation cools as predicted, then the Bank of England could pause further rate cuts, and this is going to weigh somewhat on the pound. So the key factors looking at this CPI coming out are going to be how the data has come out leading up to it. So we've seen a recent 12% decline in energy costs following a wholesale drop in gas prices. And this could lead to easing of inflammatory pressure. CPI year on year is expected to drop from 2.2% to 1.9%, and this would be the lowest it has been since 2021 if indeed it comes out like that. Core inflation is also expected to drop from 4.2% to 3.5%. So right now the UK and the pound are in a really crucial pivoting point, and it's going to be really interesting to see how the CPI data comes out and how that's going to affect the pound and all related pairs to it. So you should be, as a trader, ready for potential volatile movements right after the release, as the pound movements may hinge not just on the CPI data itself, but also the market expectations on how this is going to affect the Bank of England's policy and trajectory in the coming months. Looking across to the European central bank as a whole, it is also in a really interesting point right now, and it's set to make a critical decision at its next policy meeting on the 17th of October. The markets are largely expecting a 25 basis point cut, and this is coming after the previous 25 basis point cut we saw in September. So this would mark the third rate cut in the ECB in recent months. If confirmed, the key interest rates are going to drop to 3.25%, with another similar reduction expected in December to drop it down to a further 3%. Now, some of the key factors that are going to impact the ECB's rate cutting decision are things like inflation trends. The Eurozone's inflation dropped to 1.8% in September. This is well below the ECB's 2% target. So there are some rising concerns that they may have overshot their policy, and they may have overshot what they were trying to do. This decline was largely driven by falling energy prices as fuel expectations, and this has fueled expectations of further easing. Economic weakness. Several Eurozone economies, including Germany, are showing signs of contraction, and recent surveys indicate shrinking business activity, further compelling the ECBs to adopt a more accommodative policy towards supportive growth of the entire whole. So how this is going to impact things like the euro and how it's going to look against the US dollar. There's the anticipation of another rate cut for the euro. Could see a euro USD dropping down to 1.09 on the charts. And if the ECB delivers on expectations, the euro could see further downward pressure, while a surprise decision may have them hold steady where they are. So this meeting is going to help steer where the Eurozone's economy is going to be. It's going to be really important, as this decision is going to have impact not just as the meeting information comes out, but also what the overall economic trajectory of the Eurozone is going to be like for the rest of the year. So we're in a really cool point in the trading environment this year. A lot of big things expected to happen, a lot of important key information expected to come out this week, and this is going to impact how the markets are going to look going further. So as a trader, this is your time to capitalize on this opportunity. If you would like to make some profits, get a little bit of trading capital along your way, you can go ahead and sign up for a Vault Funder challenge. You can use the code in the corner, FISA, to get 35% off your challenge today, and take advantage of the opportunities that are presented with ourselves. With ECB, with the ECB's rate cut decision coming out, with the UK CPI, with US's retail sales coming out, these are opportunities that you will be able to capitalize on and make some profits along the way. So I hope you've enjoyed this. If you did, click the like button. Go ahead and leave us a comment of what you would like us to cover in the next episode. I've been Ed Cat. You've been watching Traders Next Door, and you have heard the Daily Scoop.